We know these markets have been tough, so tough that investors and some companies are stressed out. TheStreet's Real Money has created a stressed out index, and there are 4 energy companies that have now made that watch list. Carleton English, writer and analyst at TheStreet Portfolio Products, joins me now. So Carleton, what does it mean to be on this stressed out list?
Sure. So these companies are ones that have unsustainable debt loads. They've been issuing debt in order to finance their debt obligations. So there's some investors who may be lured by, the single-digit stock prices for some of these companies. If they buy now, really all they're doing is financing these companies' ability to pay off their so-called credit card.
So let's get to some of these stocks in the energy sector you've written a lot on. Chesapeake Energy, this is one I know that seems to have bad news every other week, really.
Almost every other day. So the most recent news on Chesapeake Energy was on Friday it suspended payments on its preferred dividend. So this is very significant. They're looking to use those savings to buy back some of their debt at a discount. But preferred shares, they operate almost like a debt instrument. They're kind of in that weird hybrid space. So the fact that they would suspend this dividend is definitely alarming.
How about Southwestern Energy?
Sure. So Southwestern Energy, it's the same story with all of these companies. The big news for them recently has been that last week they announced that they plan to lay off 1,100 workers, which is approximately 45, almost 50% of their workforce, all due to low energy prices.
And Petroleum, this one's having credit issues.
It is, absolutely. So the one that alarmed me with this company is they have a $62 million debt obligation coming due in March. And as of their third quarter earnings, they only listed $25 million in cash. So, I'm looking at older numbers, but it's just, where's that money going to come from?
And how about Encana?
Sure, Encana. So they are Canadian-based, and following the news, you see that Canada is really worried about the low energy prices, saying that it could cause a recession there. And in the case of Encana, for them to service their debt, a lot of analysts on the street are saying even if they're able to sell assets, it won't be enough to save them.
So being on this list, does that mean there is a high risk for a potential default or something worse for some of these companies?
I hate to sound alarmist, but yeah, absolutely. You're going to wonder, how can these companies service their debt, and what will they do to fix it?
All right, Carleton English, thanks so much. Appreciate it.
Thank you.
I'm Rhonda Schaffler for TheStreet.